Good morning. Welcome to today's webinar brought to you by MACF and Florida Makes. I'm your host, Sherry Reeves, along with Christian Davison. Today is November 17th, 2020, and we are starting the program at 11 a.m. Eastern Time. Today's topic, managing risk, understanding supply chain exposure, how they can impact your business in a COVID world. IOA has been a proud member of MACF since 2008. I would like to introduce our three panelists, starting with Bill Rush. Bill graduated from the University of Florida, go Gators, in 1978 with a degree in finance and an MBA in 1980. Prior to his insurance career, he was vice president of commercial lending at a local bank in Orlando. In 1985, Bill began his insurance carrier and spent 16 years at a third-party administrator overseeing all underwriting and policy services. He joined IOA in 2001 as a commercial lines producer and became a stockholder in 2003. Bill currently is the Florida managing partner. Next, we have Andrew Lockhart, graduated from Palm Beach Atlantic University in 2010 with a degree in marketing. Prior to his work with IOA, he worked for Chick-fil-A Inc. as a grand opening supervisor, traveling the country helping open new stores. In 2014, he joined IOA as a commercial insurance producer, and in 2018 became a stockholder vice president. To round out our panelists, we have Kevin Lagas, an industrial engineer consultant. He earned his master's degree in industrial engineering from the University of Central Florida, go Knights, and has worked with notable manufacturers such as Lockheed Martin and Siemens. Welcome, gentlemen. A few housekeeping notes. As a participant, your audio will be in listen-only mode using your phone or computer, whichever is more convenient. Additionally, you will have the opportunity to ask your questions using the question window. This is a live webinar brought to you and is recorded. A link to the recording will be provided to you within a few days. Now, I'd like to turn the presentation over to the IOA team.
Well, thank you, Sherry, and Christian, as well as the MACF and Florida Makes, for hosting this for us. We're excited to be here to talk to you folks about the fun topic of managing risk and just analyzing how to navigate this COVID world. As Sherry said, I'm Andrew, and we also have Bill and Kevin here, so we'll go ahead and jump into it. As was the title, Managing Risk, Understanding Exposures in Supply Chain and How They Impact Your Business. So some of just general housekeeping for today's discussion. We're going to talk to you about the state of the insurance market and how it affects your business. We're going to talk about COVID-19's impact on the market and our insureds and some of the trends there. Then we're going to discuss a little bit about exposures for your business and as they relate to COVID and the insurance marketplace. Ways to prepare and pivot your business according to your risk tolerance to help control costs and just kind of navigate COVID, as we've said. And then finally, we'll discuss supply chain and production efficiencies. Kevin, who is our industrial engineer, has a lot to offer for that through his time working with some of our clients here at IOA. So I'll keep going and jump into the insurance market. So this is the worst market at the worst time. And what we mean by that is the market from a rate perspective continues to go up. And so while many companies, probably some of y'all's companies on the webinar today, have seen pivoting or a reduction in revenues due to COVID, simultaneously to that, we've had rates continue to go up. So it's just a tough time right now between rates and revenues for some companies. We just want to mention insurance company profits. So the way the insurance companies profit are twofold, and I'll go through both of these. Underwriting income is the first, and that's kind of the standard way people think of an insurance company. They underwrite a risk. Claims happen that are a cost to them, but they take in premium, and the difference would be profit. There's some operational costs as well, but that would essentially be their income. And then also they have investment income, generally done through the 10-year bonds or safe investments like that. And they're regulated by, in this case, the United States government, but whatever government entity that they're under, if it's in other countries. And so investment income is they are holding on to your money, and as long as they're not paying out claims on it, they have the ability to invest that money to create further income. So the issue that we're seeing is in 1990, the 10-year bond rate was 8%. Today, it's 0.6%. And even 18 months ago, it was in the 2.5 range. So we've seen, even in recent years, a pretty significant decrease in the return on the 10-year bond, which is having an impact, obviously, on the investment income for carriers, which means insurance carriers must have an underwriting profit today, which means they have to charge us, the insureds, you, the insureds, more money so that they can make up for the losses they're taking on investment income. All lines of coverage, with the exception of workers' comp, especially in the state of Florida, workers' comp continues to be a soft market, we call it, where rates are continuing to go down. Last week, we just found out that the state of Florida has requested NCCI to move forward with a 6.6% decrease on rate average. So we'll see another decrease effective January 1st of 2021. So that's more great news. Outside of that, the market continues to trend up. And as I've said multiple times, rates are going up. And we'll have a chart on that, I think, on the next slide that'll show a little bit more in detail about that. Social inflation is another impact that we're seeing in the insurance industry right now. And so what is it and why should we care? Social inflation essentially is settlements that are settling at a higher value than they would have 5, 10, 15 years ago, due mostly to social issues, whether it's just a judge deciding that they would want to rule more favorably in favor of a plaintiff, giving them a greater payout. We've heard many examples. I'll even give a quick example. We had an insured who owned a shopping plaza, and a person tripped on a crack in the parking lot. It was a small crack, and the person was not working or anything. They sued the plaza and ultimately were awarded the full policy limits that our insured was carrying, which was $10 million, because the person wasn't able to play the cello in their spare time anymore. So that's a very extreme example, but we're beginning to see social inflation and social issues like that have an impact on how claims are paid out and looked at, not only by juries, but also by judges. And then just worldwide claims activity. We'll get into that in a couple slides. Bill's going to go over a couple specific quick examples of worldwide claims activity, and he'll also talk a little more about reinsurance. But the worldwide claims activity is having an impact on reinsurance, which is insurance for insurance companies. And Bill will get into that a little bit. And this is a quick chart. This is specific to auto insurance, as auto insurance has been the hardest line of coverage for the last 5 years, 6 years or so. And we're seeing, as you can see here, through the fourth quarter of 18, that's as far as the data they have that they're willing to report on, because what we're seeing is lots of lines of coverage have a long tail, meaning it takes a while to adjust them. So that just shows rates and how they're going up over the last 5 years. And then the next, we've got this chart. So this is the forecasts through 2020. And I'll leave this up here for a second, but we can see all lines, really with the exception of workers' comp in the middle, are seeing major increases. Commercial property, 10 to 20%, and up to 30% if you're in states like Florida, where most of us are. General liability, some of that has to do with the social inflation. Umbrellas, that has a ton to do with social inflation. And I'll let you just quickly read down those. But we can see that the trend here, and what I've been talking about the entire time, is rates are going up due to a multitude of factors that are causing us as business owners to really think, how do I strategically think and put my business in the right position to get the best rates available, so that it's a positive impact for my business. And Bill, I'll let you go ahead here.
Sure. Thanks. I will say the chart that Andrew just had, we just got the update for the second quarter, really, I'm sorry, the third quarter of this year, and the impact of rates is accelerating. I've been doing this a long time. I've been doing this 35 years. I've never seen a market like this. As Andrew says, it just comes at the absolute worst time for our insurers and businesses. So the insurance market has always been global, but it's never been more global than it is now. Everything is interconnected. Like basically, you can use the internet as an example. So what happens overseas impacts us. You can look at Australian brush fires early this year. Andrew, just clip on down there. Lloyd's estimates 109 billion of COVID losses, and that's without any U.S. real losses. Civil unrest, we don't know the cost that happened through the election and all that. California wildfires, 10 billion. And then we've got, this year we've had a record number of hurricanes. We're into the Greek alphabet. And if you kind of go down all the thing, Andrew, you're going to see everybody that the losses around the world have just mounted. And property always used to be what we would call a short tail. When a house burns, you get paid out. And then we'll talk about this in a second. I'll show you a chart in a second. And then it affects reinsurance markets. So what reinsurance is insurance companies buy insurance on themselves. Let's take 9/11. One insurance company could not withhold the losses that were done on the towers. So insurance companies always buy insurance on top of themselves. You call it layering up. So big global companies like Munich Re, Zurich Re, Hanover Re, insurance companies. So insurance companies want to make sure they're a stable market and have the ability to pay claims if they get a huge loss. So they buy it on a specific type of policy and will buy it on aggregate over their entire portfolio. And reinsurance has been taking that big hit. So they're raising rates every time the treaties come up, which is January 1 and July 1. Typically, you're going to see rate increases coming into these insurance companies. And what do? They pass it on to us as consumers, because insurance companies have to make money just like you have to make money. When Andrew went over the different ways to make money, because of the interest rate decreases, insurance companies have to have a combined ratio, which is losses plus expenses less than 100%. My whole career, they've been able to make money at 105, 110% because of investment earnings. Now they cannot make any investment earnings, and therefore underwriting has changed. They're being more difficult and being more picky, and therefore capacity is being reduced, and we're seeing it and reflects in rates and acceptability and capacity of the insurance company. So Andrew, go ahead and flip on that next page. So you kind of see on the left side, the property overview. And if you can read that, these are hurricanes. You got Katrina, we all remember that, Harvey, and we got Irma, which was really 2 years ago. I can't remember, my poor memory. But you kind of see, so it's the bottom chart is number of days. So you kind of see it Katrina way back in I forget when it was, but it's basically flat. You see Harvey a little bit more. Then all of a sudden you see Irma. So how is it possibly when a property gets damaged by a hurricane that claims are still being paid out 600, 700 days later? A lot of that is business interruption, which we'll review in a little bit. So what is happening, these insurance companies are finding out that the loss they thought was going to be X number of dollars, it's X numbers times 3. And so that's caused a lot of problem on the property side. Look at the pricing trend. Again, this is from the second quarter. You got to look at the no good news on us. And this is a national average. Florida is unique in that we've got our own property problems with hurricanes. So I would tell you that our average increase is a little bit higher on property than the national average. So it's not a lot of good news on that front, but just want to kind of show what the insurance companies are facing and how it's impacting you as a manufacturer. Why are my rates going up? Why are my premiums going up? And it's all because it's all related to global in interest rates and just the results of the insurance industry over the last 3 years as far as losses. And now Kevin's going to talk a little bit.
All right. Hey, everybody. So big shout out to Florida Makes for letting me use their data here. I talked to them and they have surveyed 224 Florida manufacturers about the impact COVID has had on their business. I'm sure this is a little bit more what you're used to seeing. In fact, some of the people on this webinar might have been participating in this survey. It's a little tough to read, but the left bar chart is the degree of impact. And as you can see, over 60% of Florida manufacturers are operating at some sort of reduced capacity due to COVID. So there's a lot of impact on the way you guys are feeling things. The largest impact that everybody's seen is the slowing or lack of business. This is kind of a 180 from what we've seen in years past, where there were larger issues with workforce availability, supply chain questions. Now that we're actually seeing those issues come up and the lack of availability of business, we're kind of seeing different issues, different things you need to be focusing on than in the past to really kind of weather the storm if you are in that majority that is having issues. A little later on in the webinar, I'll talk about some different metrics you can look at to kind of get back and get ready for when things return to normal, or to hold on right now if you are seeing some reduced capacity. With that, we go on to the next slide and see the impact on insurance, not just manufacturers. You got the next slide, Andrew?
So you can go ahead on this slide too. Go ahead.
Oh, there we go. All right, so COVID-19's impact on insurance. So some businesses have flourished while others have changed or pivoted. It's kind of the tale of two cities, as you've seen. Some people are staying normal or in fact seeing increases in their business, and others are seeing a large decrease. And so what you really have to start looking at is, do you understand your exposure if you have to pivot or do something different? What we mean by pivoting is looking into different lines and different products. If you had to do something else with your business, for example, I've worked with one company that used to distribute golf carts to venues for concerts and NASCAR. And with COVID, they couldn't do any of that. So they really were looking for different ways they could utilize their golf cart inventory to produce business in a time when large social gatherings aren't really an option. They've become a transportation company doing last mile deliveries for Amazon, using those golf carts in a similar way. What we really need to understand now is, how does that impact their business? How does that impact their insurance now that they're more of a logistics company than they were before? And so it's, at times like that, it's very important to understand, have you changed your exposures? Does the policies you currently have cover what you're doing? Where before they were giving these, they weren't driving on official roads, now they are driving on official roads, delivering these products. That's a different type of coverage. They had to go through and make sure I'm covered for these things. There was a few tweaks they had to make to understand they weren't doing anything they shouldn't. Another one is, do you understand your insurance costs if your business is moving? Like Andrew and Bill said, we're seeing some negative trends in the market in terms of prices going up. If you're doing well and your prices are going up, are they matching market trends? So the ways you can kind of take a look at this is audit your additional premium. Take a look at any classifications. Take a look at the way you're having to pay to see if there's something out of the norm, to see if there's something that just because your business is doing better and your price is going up, is it going up in accordance with what everyone else is saying? It's the time to kind of look back and see, am I getting the best out of my insurance spend? And again, with COVID, this has just been difficult to really track on because there's so many different variables going on throughout the world. Another point you need to consider is, how are you keeping up with your employees' claims while business booms? You can focus on expanding, or you can focus on safety and quality processes that have long-term impact. And really, you could look at this if your business is booming or not. I know, at least with my consulting, when I've been in businesses and really tried to overhaul safety or overhaul a quality process, the answer I hear 9 out of 10 times is, we don't have time to look at that. Oh, if business isn't booming right now, that's really the time you can ramp up your quality, because demand should return. We should see things similar to what we did last year, at least from the manufacturing perspective, and taking a look at what different processes you can do now. And if you're booming, take a look now, see what you can do while you don't have to focus on selling or pivoting like some companies might have to. you can spend this time and extra resources to really improve your company for the future.
Kevin, let me jump in a little bit. I think 40%, sounds like close to 40% of the survey results was that, I mean, we are really doing okay. In fact, we're at capacity, and they may be over capacity. So when you're just trying to figure out how am I going to not only stay in business, but maybe thrive in this business, and I have to add extra shifts, things like that, all of a sudden you don't want to lose sight of things like safety. I'll stay on workers' comp for a second. Every employer over $5,000 in premium has what is called experience mod, and it's the gift that keeps on giving. So if you lose focus on your safety and you have a serious accident, that is going to impact you for 5 years. That claim today will start showing up on the 2022 experience mod for 3 more years. One of my favorite sayings to my clients is prevent the preventable. Don't lose focus on the process as you expand out or try to pivot to different products. We've got clients that went from a furniture cleaning to providing process to doing hand sanitizer. Big exposure difference there. The insurance companies want to know about it. They want to make sure they charge for it. So you don't want to be caught at audit and say, oh gosh, I didn't have that class on there. I've got $5 million of revenue on this class, and it's double my other rate classification because it's a different occupation, different type of operation. So just all I want to say is that just be aware when you change your operation, it does impact your insurance.
Mm-hmm. Yeah, the way I like to look at that is proactive versus reactive. There's things you can do for your company to either react to things and hope they'll work, or look down the road and say, what changes do I need to make now to prevent the headache later? And I think that's a really big part of it, is taking the time to look at your insurance classification codes to see if any changes you've made to your business change the way those operate. Maybe give your insurance agent a call, make sure that everything's looking in line so you don't get caught with a headache later of you weren't covered for something that you thought you were. So the next point here, court cases around the country. Go ahead, Bill.
I was going to say, speaking of being caught unaware of what you thought you were covered, this is right here. Speaks to the point. When COVID came, people had to close. And so, well, I've got business interruption coverage. Well, business interruption, as has been pointed out through court cases throughout the country, rely on direct damage to your premises. And most policies now have virus exclusions. So what people thought, gosh, I think I've got coverage for business interruption, which, by the way, business interruption, just so you know what that is that it covers lost profit plus continued expenses if you had a loss of, say, a fire to your manufacturing and you cannot operate. With COVID, courts are finding that there was no direct physical loss, as a virus is not a physical loss. But there's been a lot of litigation in that, and that's what this point is. There's only been one case, lower case, that's found evidence that a virus is a physical loss. Every other court in the country to date has found there's no coverage. Just want to kind of bring that up. And I'll kind of go on. What has been impacted directly by COVID-19? And you'll see a lot of the management liability type claims. Employment practices, that's where you sexual, racial harassment, wrongful termination, and that's what insurance companies are absolutely scared of getting these claims of all these terminations of employees. And so what we've seen already, we've seen in premiums just spike up on this line, and retentions or deductibles increase dramatically on this. Insurance company underwriters and claims folks just don't know how their insureds are going to be impacted. Are they going to go bankrupt? Are they laying off people without cause? So it's caused a big problem in this line. Directors and officers, which primarily for public companies, you have insurance companies scared to death of investor suits, saying you didn't do enough precaution. We're concerned about your financial ability to continue. Then we have cyber, which is a lot of people working at home. I'm working at home right now. There's concern that the criminals, the hackers, are able to get into systems much more easily. We've seen a lot of ransomware, which hopefully no one's been affected. It's a nightmare trying to deal with that. And then on property and other lines, we're seeing right now already exclusions and limitations on viruses, contamination, things like that are insurance companies are lasering in on right now to make sure they're not covering stuff they don't believe they should be covering. I'll keep on going. So here's all the, as I said, cyber is a disaster line. It's gotten nuts. So if you look at your policy or have your agent look at your policy, see if you have something called bricking. So what that is when the hackers get into your system and destroy your hardware so badly, it turns your computer into a brick. So you're seeing a lot of claims coming on that side, particularly after ransomware. I've actually had a client who had a network service provider get hacked and spread all the ransomware into their clients, a number of clients. So my client got hacked. Fortunately, he had backups and all his computers were not tied into the network. So he was able to back up and did not have to pay the ransomware, but they were asked to pay $100,000. But because he had a good cyber policy as well as good procedures, he was able to avoid that. Internet of all things, everything's connected. So that's scaring underwriters to death as well, because as a manufacturer, a lot of your machinery are connected. And what happens if it gets a wrong command and it freezes up your computers inside the machines, and it just destroys the machines? This is the war we're fighting right now with under this coverage. Talk about ransomware. Then we've got something called silent cyber. This happened about 3 or 4 years ago. The parent company of Cadbury Bunnies got hit with this thing, and it cost a $3.3 billion loss. And they filed a claim under property because their computers got destroyed and such. So cyber bleeds into other policies, and now we're seeing insurance companies start to address that and try to make sure they don't pay a claim outside of cyber. So that's this again is just a very line that's in a fluid part of coverage and pricing on that because of the claims they've been having. Go ahead, Andrew. Okay, so the next one, just a lot of you folks obviously have suppliers, main suppliers. So you get a call from somebody at 3 a.m. and saying, "Hey, this is Pete from XYZ. Our plant's gone, and we're not going to be able to supply you for 8 months." You make calls around. You cannot get your component that you need to make your product for 3 months. What do? Again, this did not happen to your plant. It happened to your supplier, or could even happen to your biggest client downstream. There's something called contingent business interruption, which is different from your direct business interruption. I would definitely make sure, if you've got critical suppliers, make sure that you talk to your agent about contingent business interruption upstream and also downstream. If you have a critical client that they have a loss at their facility and cannot take your client or your product anymore for 3 or 4 months. I think the statistics, folks, is that 70% of businesses don't get going again after they have a catastrophic business interruption loss if they don't have insurance. Please make sure and talk to your agent about covering not only your direct, but also your contingent if this applies to you.
So I'm going to jump back in if that's okay.
Yep.
So what now? Really, what we're sitting here talking about, a lot of insurance can end up being a discussion about all the bad and the doom and gloom. But what now? So what do we do now? Really, the easiest thing and the best way to start, as Kevin was talking about a few slides ago, is just budget accordingly. If your revenues are going up, generally that means that you're probably going to be paying more. If you are changing classifications, adding different job types and occupations to your business, again, just make sure you understand the cost impact there. Renewal strategy is another great one. The first thing we say is work with an agent you trust. In our business, oftentimes people talk about shopping insurance. And in most cases, agents have the ability to shop with all the necessary carriers. So make sure you have an agent that you can have an open and honest discussion with, and you trust them and trust what they're doing for your business. To that end, hard market equals market hard, and that's the responsibility of your agent in this market to make sure that they are talking to all insurance companies, to make sure that you are positioned the best you can from a story they're telling perspective, but also just that you're with the right carrier who understands your business and also is just the most price competitive. As I just mentioned, the full story equals the best pricing. And what we mean by that is if they clearly understand your business and can get the underwriters can get their heads wrapped around it, generally they're willing to give concessions where necessary as long as they understand any safety procedures you have. So do you understand the story that's being told about your company? That's really the question to kind of ask yourself. With us at IOA, we always have conversations with our clients, telling them, hey, here's the conversation we're going to be having about your business with underwriters. Does this make sense? Are we accurate here? Let's make sure we're telling the correct story. Another thing to consider is coverage changes. We always take pause when we talk about this one, but everyone has a different risk tolerance, especially in an entrepreneurial type business. So are you paying for too much insurance or too little insurance based on your risk tolerance? So that goes back to the conversation with your agent, having that conversation. Hey, here's kind of where I really feel like I'm comfortable with my business from an insurance perspective. Can you help me get there, and what's the pricing look like? We always say, you do want to cost benefits. Oftentimes you'll take on a higher deductible to save pennies. And so that generally doesn't make sense, but that's the responsibility of your agent to look at a good cost benefit analysis and show that to you. Take on more risk, which I was just mentioning. So some ways to do it are increase deductibles, like I mentioned, but do your homework, cost benefit analysis. Self-insuring completely, which can be if you feel comfortable, if you have a small building, or generally we're thinking physical assets here, not so much liability, because liability is such an uncontrollable. But what are ways that you can comfortably self-insure your business? Captive programs, which are ways to control some of the costs and share in the costs of the insurance with your business. You do well, you get more money back. You do less well, we know where our ceiling is. It's just an opportunity to find a way to be a little bit more competitive based on the way you operate your business and how safely you operate your business. And then Bill kind of mentioned this earlier. He says prevent the preventable, control the controllable. Make sure that you understand your exposures, how they could have a negative or positive impact on your business as it pertains to risk and insurance. This is something that IOA takes very to heart as agent for our clients. We have a division within IOA called Risk Services, and the job of our Risk Services department is to provide training after a claim, any reactive approaches to managing claims, training from a proactive perspective, and kind of everything in between. Because we believe as your agent, we not only provide you with the policy, but we help you manage your risk throughout that policy period to be at the most benefit for your business. Kind of said all of this. The last point there that just came up is manage relationships with customers. Do your due diligence. Oftentimes we'll see clients who take on a new customer because it means potential pretty large spike or increase in revenue. But what's the downside? Do you understand the risk protocols that client have? And is there a way that it could feed uphill to you and negatively impact you from a risk perspective? So it's just vetting and managing the relationship you have with any new clients to ensure that they're covering not only themselves, but also you. And that can be done through contract language. It can be done through just sending someone out to their facility to ensure that they're managing their people well, et cetera. Risk transfer strategies, which we discussed quite a bit. All right, and now we'll let Kevin go on what Kevin does great, which is efficiencies. So Kevin, go ahead.
All right, sounds good, everybody. So what I'm going to be talking about today are a couple metrics you can use to see how you can improve your business. Everybody talks about there's projects you can look at, Kaizens you can hold, different things you can do to start tackling your business. But the real question is, where do you start? And I found the best way to do that is to do a couple of more difficult to track metrics, maybe something that you've heard of but not done before, to kind of get an idea of where to look. So the first one we're going to be looking at here is the carrying cost of inventory. I found most manufacturers don't necessarily look at this, and anyone with a distribution center, any kind of storage, I think this is one of the most important. It really kind of takes all the different costs and gives you a real pulse of your warehouse management process. So to calculate the carrying cost of inventory, it combines your storage costs, so what you're paying in rent, utilities, things like that, employee salaries, opportunity costs. This is one of the more difficult parts of this equation to really pin down, especially now. When you're looking at opportunity costs, you're looking at could you have a different product on the shelf? What would the selling point of that be if you had more product X instead of product Y? All sorts of different things, ways you could pivot that you couldn't now. And trying to put a dollar value to that can be difficult, but again, to the best of your estimate, what are you missing out on with your current configuration, and including that dollar value there? The next is depreciation costs. This doesn't apply to every manufacturer, but if you have some sort of food product or something with a shelf life, this definitely needs to be taken into account of how well you're managing that inventory. And then you divide all of these sums together by the total value of annual inventory to give you your carrying costs. So again, this kind of takes a lot of pieces together to show you where you're at. And then what I like to do with this metric is then test what if scenarios to really see what impact you would have on your business if you tried different methods. The best success story I've seen with this was a company that had two different warehouses, two different parts of the business, took a look at a carrying cost of inventory, tried what if scenarios about reducing employee costs, and found that purchasing a new, larger facility was actually the most beneficial way for them to improve their company versus trying to buy more racks. There was a couple other things they approached, but combining both facilities and reducing redundant employees, they repurposed the labor elsewhere because they were booming, but it really helped them improve their business as efficiently as possible. It's a way to take a look at how to trim the fat, because you can look at the different costs and see how you can remove those. And again, it's a great way to do a cost benefit analysis for a warehouse management system. Next slide, please, Andrew. There we go. So the next one we've got here is order, pick, pack, and ship accuracy. This is something most manufacturers do already keep track of. They take a look at how, if there's an issue, if something got sent to the customer that's incorrect, how do you take a look at that to prevent it in the future? Again, if this is something you can look at whether your business is thriving or if you're operating at some reduced capacity. If you have the extra time to look at this right now, this is a great way to improve client relation, really increase your accountability and your reliability to your customers if you can make sure every time what gets shipped out is what they wanted and it's in a presentable manner. So what you're really looking at with this metric is what part of the system breaks down. Instead of just looking at if a product got shipped out that was incorrect or damaged, take a look at what part of the process actually caused this. Maybe put in a system to check the progress at each step. One example of how I've used this, where I was working with Siemens in one of their distribution facilities that sent parts to wind turbines all over the world. These were replacement parts, so if a wind turbine was down, someplace could potentially be out of electricity. They were seeing up to 3-day delays in their order delivery process, where a part could be sitting there, but because of the backup and the issues, up to 3 days delayed because they were going so slow to make sure the correct part was sent out. There was ways they could approach their system. They had assumed that their issues and the slow turnaround time was from the packing process. Once everything had been picked, the labels being put on, the meticulous care being put in there was what was slowing down their system. After running an order, pick, pack, and ship accuracy study, we saw the actual issue was from the forklift drivers picking incorrect or damaged products from the shelves. And so we were able to go through, and by adjusting that part of the process instead of the part they thought was the issue, we're able to reduce that turnaround time to 1 day. So within 24 hours, they were able to get their parts out and to ship to different parts of the world. This is a really good way to be proactive versus reactive. Like I think I said earlier in the presentation, just different ways to take control of your company and make sure you're making changes before there's an issue. And again, this could really help regardless of which side you're on of increased or decreased demand right now. Want to get to the next one, Andrew? So here's another one that can really apply to both. So this is capacity utilization. I can guarantee you anybody who makes a product is taking a look at this. And it's you divide your actual output by the potential output of a person, a unit, a machine, to understand how much you're making use of this. And the problem with capacity utilization is it's not as simple as everybody likes to think. Everybody knows if you take a look at capacity utilization, you have 2 machines working at 40%, you sell one. It's almost never that cut and dry when you're looking for solutions. It's about matching the level of utilization all the way through your stream. This will help make improvements. It'll help really try to get to that takt time. So takt time, I'm sure most of you are aware, is the German word for cadence. And this is manufacturing, 1, metric you can track, but 2, philosophy that each step should take about the same amount of time so you can really optimize your business. Capacity utilization can help you understand why one step might take longer, why one step might be being underutilized. Look at places to expand. Again, going to an example of how I've used this, we worked with a wood manufacturer that had purchased a new large CNC saw. They were getting expected a large amount of output from that and realized they couldn't match it downstream. And they had to look at and see where they could put now that they had almost doubled their input, how they were going to match that to also double their output. So using capacity utilization, we were able to look and see which downstream saws had a little bit of capacity you could move certain processes to really try to get to that even step time for all steps. And it helped increase, they did reach almost double their production by just moving around different parts. It was just the one purchase of the CNC saw and making sure everything lines up with production. This is a great way to take a look at that. And I think that just about wraps up all of the metrics we had. And I think we've got some time for questions if anybody has any.
Before we take questions, I did just want to, we should have done this at the beginning. Kevin is, like Sherry kind of introduced him, is an industrial engineer. He works for IOA. He is available to IOA clients. So that's one way to get to Kevin. Kevin also does have, he can do something separately through his own fee arrangement. And then also, Kevin, do you want to talk quickly just about kind of your relationship with Florida Makes, if they have any interest in kind of getting your view into their business and how they can utilize Florida Makes?
Yeah, absolutely. So IOA is a registered third-party provider for Florida Makes. So with your MACF memberships, I'm sure you all know, you can get a free assessment by Florida Makes to come through, look at your company, give you a list of ways they think you can improve. But what's so great about them is they can also secure grants to help pay for the improvements that you recommend. So this is something where, for example, with my services, if we came in and determined there are some efficiency things you could have, a large project, maybe redesign a layout, take a look at one of your streams to make sure every step works the way it should. Florida Makes can go through and pay for part of that fee. Or as Andrew said, IOA customers, I go in all the time and help them understand things from a consultative level. And again, the best way to look at this is to take metrics, try to do this on your own. Get the lifeline of your company, get the pulse, understand where you need to improve, and then try it yourself. And then if that doesn't necessarily work, that's when you bring in the outside help. I'd love to have a conversation with you if you try one of these metrics, identify something, and then need extra help to be able to solve it. That's where that outside help can come in. But again, Florida Makes can help you pay for that. IOA is a great avenue for this. I'd love to just have a conversation to see how we can help your company.
Thanks, Kev. Yep. So now we can, if anybody has any questions, feel free.
Thank you, guys. Like they said, if you have questions, there's the question box on your screen. Just type your questions in there. They'll come straight to us and we can get your questions answered. You can also use the chat window if you'd like, and that will go out to the entire audience. So type in your questions either in the question box or in the chat window.
So what if we're waiting for some of those? One question I sometimes get after talking about stuff like this is there anything additional I can do, especially if you're in that category of not having reduced demand? If you're busting at the seams, if you're trying to do everything you can to just keep just get product out the door, you're slammed with just making sure you get everything done, I would say take a look at throughput. Again, this is one everybody looks at. But it helps you understand, are you capable of meeting demand? Is demand going to continue to increase? It helps you see what areas are falling behind. And again, it's just a nice litmus test to understand, where do I need to improve? What is holding me back from meeting that higher demand? What steps do I need to take to fix it? Is it an employee? Is it a station? Is it an entire workflow? Just taking a look at the throughput and what the capacity of each actual unit is to help see what bottlenecks you have. It really helps you take a look, see, okay, if this can produce this much, why? You can see anything with metrics. The real question is why, and what are you going to do about it? And I think that's where taking a combination of metrics can really help you understand what the best approach is.
And I'd just like to add, Christian, as far as IOA, we're a large agency, it's the largest privately held agency in Florida. Just kind of a quick commercial. If you're a little bit concerned or want a second opinion about your insurance coverages, make sure you've got what you believe what type of coverage you need to have. We'll be glad to talk about, and also we can make recommendations as far as what we may not see in your current policies. The time to find out you're not covered is not after a claim, it's before a claim, so you can make some business decisions whether you want to get that covered or not. So we'd be welcome to help you. We love our Manufacturer Association, helping our fellow members. And feel free to reach out to Andrew and I on the insurance side, and certainly Kevin on the industrial engineering side.
Kevin mentioned earlier in the presentation about companies who have had to pivot either what their products are or their business model to keep up with the changing COVID world. We had a lot of our manufacturing companies pivot to start making PPE as a way to keep their employees working. Are there any types of changes in coverage that you could think of, or maybe things that they might need to consider as far as changing their business model with PPE?
Well, this is not normal, but it does happen. Sometimes insurance policies have designated operations, so they would spell out what type of manufacturing they do. And if you pivot to a different manufacturing product, there could be coverage issues on that. But in terms of, I would just can't encourage you enough to talk to your agent and make sure they know about it, so the insurance company knows about it, because you don't want to be in a situation where insurance company says, what did you do? Well, you needed to tell us when you started doing that. So I would just reach out to your insurance agent if you've changed operations to make sure that you got the right coverage in place. Again, a lot of it.
Yeah. Go ahead.
Go ahead.
I was just going to further that and just say that it also depends on the type of business. So if they're manufacturing something that from the actual manufacturing process has a low impact or low potential hazard for their employees, and then also low potential impact for their customers, or similar generally it can be a common sense thought. It's like, okay, I'm manufacturing paper and now I'm manufacturing paper masks or whatever it is. That's not a great example versus if they're going into something that's obviously a much more heavy manufacturing process from a lighter one. That's where you'll just want to be thinking from a cost perspective and a coverage perspective. All right, I clearly going to PPE or hand sanitizer or whatever it is very different than the metal manufacturing I was doing before. Maybe there's some potential savings there. So oftentimes it's just a common sense thought to start and then reach out to your agent and say, hey, am I thinking about this right?
I will say there have been a lot of hand sanitizers being recalled because the ingredients being used were incorrect. So that, could obviously cause a problem. So I want to bring that up.
Christian, do you see any other questions?
No, I'm not seeing any other questions.
Okay. Gentlemen, do you have anything to add?
No, just thanks for the participation. Thanks for listening. And again, feel free to reach out to any of us regarding anything related to insurance or help on your manufacturing process.
Well, we would like to thank
you,
the IOA team for their time today and many years of experience in the insurance and manufacturing industry. Not all insurance carriers, I like to say, are the same, and that you guys do understand the manufacturing arena, which is very important. We'd also like to thank Florida Makes once again for their continued support of Florida manufacturers. We'd like to thank you for your participation in today's webinar. And if you'd like more information about MACF, please visit our website at macf.biz. For future events, please visit our website. We do have an upcoming event, our Jingle Mingle, coming December 3rd. As you exit the webinar, we are seeking your feedback about how to improve these webinars and better meet topics of value to you. Please watch for upcoming webinars through MACF and Florida Makes. And we bid you a good day, stay well, and keep manufacturing. Thank you.